We all have that dream, right? Finding that one stock, the one that could just absolutely explode and 10x our investment. But let's be real, how do you actually find one of those companies before it's on everyone's radar? Well, that's exactly what we're going to break down today.
It's the ultimate question, isn't it? The market is just, well, it's noisy. It's full of hot tips, speculation, and literally thousands of companies all fighting for your attention. So how in the world do you cut through all that static to find a real solid signal? How do you spot the next big thing when it's still, just a small thing?
To really see why this matters, let's just rewind and look at a classic example. Blockbuster. Man, they were a giant, but they were stuck in the past, completely blind to the massive shift to digital. And then you have Netflix. They saw the future coming. They got that streaming wasn't just some fad, it was a fundamental change in how we watch, well, everything. One died out, the other became a titan. The key difference was seeing where the world was headed.
Okay, so here's the most important takeaway. Finding the next Netflix, it isn't about getting lucky. It's not about some secret tip you heard from a friend of a friend. It's about having a repeatable system, a process for sizing up a business. And that's what we're digging into today, a framework we call the analysis funnel. Think of it as a systematic way to filter through the thousands of options to find the truly exceptional few.
So our funnel here has 6 key layers. We're going to start really broad with moats and megatrends, and then we'll do a quality check to find some stability. After that, we'll scan its financial health, measure the growth engine, figure out what's a fair price, and finally, we'll put it all together. So let's jump right in.
All right, the first layer of our funnel is the widest one. Before we even think about looking at a single number on a balance sheet or a stock chart, we have to ask a very simple but crucial question. Is this a great business? This is all about the story, the qualitative stuff.
And probably the single most important piece of that puzzle is whether the company has what investors call a moat, a durable competitive advantage. I mean, just picture it. A moat protects a castle from invaders, right? Well, a business's moat does the exact same thing. It protects its profits from competitors. A company without a moat, honestly, it doesn't matter how great its product is today, it's always going to be vulnerable.
So what do these moats look like? Well, they come in a few key flavors. First, you've got high barriers to entry. I mean, just imagine trying to build a brand new railroad to compete with an existing one. The cost is insane. Then you've got switching costs. This is like when a business is so hooked on a piece of software that ripping it out would be a total nightmare. And finally, my favorite, network effects. Think social media. The more people that join, the more valuable it becomes for everybody.
Okay, so let's say we've found a company with a really strong moat. Awesome. Now we go to the next filter in our funnel, the quality check. What we're asking here is this business stable and predictable enough for us to even try to figure out what it's worth? Because an unpredictable business is almost impossible to invest in for the long haul.
To really see what I mean, let's make this real. We're going to put 2 actual companies head to head. Let's take a look at the financials for Disney versus SiriusXM Radio stretched out over a decade.
First up, Disney. Just look at this chart of its equity. That's the company's net worth. You see that? It's a clear, consistent, upward trending line. It's smooth. This chart just screams stability and predictability. Year after year, the company just reliably built its value. This is what you want to see. It gives you confidence.
Now, hold that image of Disney in your mind and look at this, SiriusXM. Over the exact same period, its equity is, well, it's all over the place. It's jagged, it's erratic. Trying to predict this company's future based on this chart is a total shot in the dark. You can't forecast 10 years from now when you can barely guess what's happening next year. And this comparison really hammers home a core idea. You can't calculate the future value of a company if its past is total chaos. A great investment has to be calculable. Without that foundation of stability, you're not investing. You're pretty much just gambling. So in our framework, a company like SiriusXM, it gets filtered out right here.
So, we've confirmed the business is stable. Now it's time for a financial health scan. And the number one risk we're on the lookout for is debt. A giant mountain of debt can turn a fantastic business into a horrible investment almost overnight.
Let's go right back to our 2 examples. Disney's debt-to-equity ratio, as you can see, is pretty stable and totally manageable. There's a consistent pattern. Now look at SiriusXM. Whoa, we see these huge, unpredictable swings. That kind of volatility is a massive red flag. We want to avoid companies whose finances are constantly on a roller coaster. All right, our funnel has now filtered for quality, stability, and financial health. But listen, for a potential 10x stock, just being stable isn't enough. We need growth. So this next step is all about measuring the company's growth engine.
And the absolute best tool for this job is the PEG ratio. It is so powerful because it connects the 3 most important things: price, earnings, and growth, all into one single elegant number. This is really the secret to finding what investors call growth at a reasonable price, or GARP.
And you know what? Calculating it is actually surprisingly simple. Step 1, you find the company's PE ratio. Step 2, find its projected annual earnings growth rate. This is super important. You can find it from analyst estimates or the company's own guidance. Then, for step 3, you just divide the PE ratio by that growth number. That's it. That's your PEG ratio.
So what does this number actually tell you? Well, as this table shows, a PEG ratio right around 1.0, that suggests the stock is probably fairly valued. If you see a ratio of 2.0 or higher, that's a warning sign. You might be paying way too much for its growth. But a PEG ratio below 1.0, especially something down around 0.5, that could be a sign of just killer value, a whole lot of growth for a very, very reasonable price.
But, and this is a really important but, if you find a PEG ratio that's crazy low, like 0.3 or 0.2, you have to get skeptical. It could be what they call a value trap. It's like seeing a Ferrari for sale for $2. Your first question shouldn't be, where do I sign? It should be, okay, what's wrong with it? You have to do your homework and investigate why the market is pricing it so darn cheap.
And that brings us perfectly to the final and tightest part of our funnel, figuring out a fair price. Look, you could find the best, most stable, fastest growing company on the planet, but if you pay too much for its stock, it will be a bad investment, period. Valuation is everything.
A metric everyone talks about is the PE ratio, but a lot of people just see it as this abstract number. This quote right here makes it so tangible. A PE of 18 simply means that for every $18 you invest, you're basically buying $1 of the company's annual profit. It's the price you pay for a slice of the pie.
But PE isn't the whole story, not even close. I mean, what about a super fast-growing company that isn't profitable yet? That's where the price-to-sales ratio is your best friend. It tells you exactly how much you're paying for every single dollar of revenue. And then, for a totally different angle, you've got price-to-book. This one compares the stock price to the company's actual net assets. Think of it as what you'd get if they sold off everything. Using all three gives you this amazing 360-degree view of whether a stock is a real bargain.
Okay, we've made it through every single layer of the funnel, from the huge big picture idea of the business all the way down to its specific price tag. So now let's put all the pieces together.
This slide lays it all out. Step 1, find a business with a protective moat. Step 2, filter for stability. Step 3, scan for too much debt. Step 4, measure its growth engine with the PEG ratio. And finally, Step 5, make sure the price is right. It's a disciplined, repeatable process for finding quality.
At the end of the day, success in investing isn't really about finding that one in a million lucky stock. It's about building and mastering a process, a framework that can help you find great companies at fair prices time and time again. The funnel is your tool. So the real question is, what's the first company you're going to put to the test?